Hey guys, what's up? Welcome back to another video. In this video, I'm going to be talking about a stock that recently announced earnings for the second quarter of 2023, and that stock is Netflix. And as we can see right here, Netflix is up over 90% over the past 12 months versus the rest of the market, which is only up 14%. So they're completely dominating the rest of the market over the last 12 months. And so in this video, I'm going to look into some of the recent news that came out surrounding Netflix. I'm going to look at their financial statements, and then I'm going to use a discounted cash flow model to figure out the intrinsic value per share for Netflix. So right here, we can see from this article, it's titled Netflix Stock Sinks as Wall Street Looks for Clarity on Revenue Growth. Two of the key highlights they point out right out of the gate include the fact that Netflix's average revenue per membership showed weakness in the most recent full quarter, and people expected a lot more revenue growth in the third quarter than Netflix ended up reporting in their earnings report. In the second paragraph here, they point out that year-to-date, Netflix is up 60%, but they've had a recent sell-off of a little bit more than 8% when they announced earnings. Their rally of 60% was spurred by anticipation for revenue growth and subscription growth from their rollout of cheaper ad-supported plans, a crackdown on password sharing, both of which were supposed to drive growth for the streaming giant. But unfortunately, it didn't really have the effect that they anticipated. Right here, they point out that the company this week removed its least expensive no ads plan in a push for customers to opt for the cheaper ad plan instead. And then also for advertising, which Netflix recently included onto their platform as a means of accumulating more revenue. They said that they expect a gradual revenue build, and they're not expecting that to be a big contributor this year. And then lastly, the last point I'll touch on here is that their ad-supported plan, which launched late last year, has so far signed up about 1.5 million subscribers, which is a very small piece of their overall subscribers. They currently have around 238 million subscribers, which is up 8% year over year. So although they haven't really met expectations, Netflix is increasing their membership, and they do anticipate that the advertising revenue is going to have a gradual build, positive build on their business. So right here, these are their financial statements. We can see for their income statement, year over year, revenue is up about 2.7% from $7.9 billion to $8.1 billion. And then we can see net income is up about 3% from $1.44 billion to $1.48 billion. On their balance sheet, we can see that total assets are up from $48 billion to $50.8 billion. And then we can see total stockholders' equity is $22.8 billion, up from $20 billion. Total liabilities is $27.9 billion, up from $27.8 billion. And we can see most of the increase in their stockholders' equity came from increase in retained earnings from $17 billion up to $19.9 billion. And then lastly, for their cash flow statement, we can see that for operating cash flow, it's up from $102 million to a little over $1.4 billion. And then for their financing activities, in 2022, they didn't repurchase any common stock, but in 2023, they repurchased $645 million of common stocks. They're definitely prioritizing returning value back to shareholders a lot more this year than they were last year. Right here for the discounted cash flow model, we can see that Yahoo Finance is estimating that the company is going to grow at 24% for the next 5 years. They had $1.6 billion of free cash flow in their most recent full year, $11 billion of net debt on their balance sheet, and then 400 million shares outstanding. Puts their intrinsic value per share at $82 per share, which means that at the current share price, Netflix is not trading below intrinsic value per share since they're trading at $428 per share. You'd probably want to buy them at a cheaper share price based on these growth rate estimates from Yahoo Finance. Then on the right-hand side here, I did a competitor analysis comparing them to Amazon and Disney, Amazon's streaming service, and then Disney Plus. We can see that for profit margin, Netflix is beating out their competitors here. For gross profit, net profit, and return on assets, Amazon has the highest gross profit, but they're not profitable in terms of net profit and return on assets. For PE ratio, Netflix is trading at 50 times earnings right now compared to Amazon's 300 times earnings and Disney's 38 times earnings, and none of the companies pay a dividend. So from competitor analysis perspective, just by looking at their profit margins, you'd probably want to give it to Netflix here. And then lastly, I want to compare Netflix to some of the other companies we've looked at. Across the board, we can see that Netflix made it onto a couple of the tables here, but they aren't really that competitive. Starting with intrinsic value per share, so far Google, Alibaba, GE, and Etsy are the only companies we've seen that are trading below intrinsic value per share, but Netflix clearly wasn't, with an $82 intrinsic value and their share price of $400 per share. For growth rate, Netflix had a projected 24% growth rate. That puts them in 6th place for the growth rate table. For profitability, they had a 39% gross profit margin, 14% net profit margin. Not good enough to get them onto either table. Adobe has the highest gross profit at 86%. Microsoft the highest net profit at 36%. Then we can see for dividend yield, Netflix doesn't pay a dividend, so they aren't going to make it onto any of the top spots on that table. But for year-over-year revenue and earnings growth, we can see that they come in 7th place with 2.7%. Tesla had the highest year-over-year second quarter revenue growth at 47%. And then for the earnings growth, they come in last place with a 3% increase year-over-year compared to Kura Sushi, which increased their earnings 240% year-over-year for the second quarter, coming in 1st place there. And then lastly, for stock performance, over the last 5 years, we can see that Netflix is up 19%, not good enough to get them onto the table. So far, Tesla has the #1 spot at 1,144% return over the last 5 years. So as we can see, they're not really that competitive on the company-to-company tables here, but they do make it onto the growth rate table at 6th place. That's about the best they got compared to other companies. For competitor analysis, they're doing better overall compared to Amazon and Disney's business, but obviously Amazon and Disney have other avenues of revenue besides just streaming, whereas Netflix is primarily a streaming company. So Netflix is going to have to figure out a way to increase their earnings and their revenue. And then currently, according to this discounted cash flow model, they're not trading below intrinsic value per share. So let me know in the comment section down below what you guys think of Netflix. Leave a like on this video, subscribe to the channel, and I'll see everyone in the next one.